Imagine checking your mail one morning and finding a letter that says your student loans have defaulted. Your heart drops. You wonder, what does that even mean? Will my paycheck get taken? Can they take my tax refund? Or worse, can I go to jail for this? If that thought scares you, stay with me, because in this video, we're breaking down everything you must know about defaulted student loans and, more importantly, how to get your life back on track. Most people panic and do the wrong thing after defaulting. But if you know the right steps, you can turn this around faster than you think. Number 1. What does defaulted student loan actually mean? When you take out a student loan, you agree to repay it in regular installments. But when you stop making those payments, your loan eventually goes into default. For federal student loans, that usually means you haven't made a payment for 270 days, which is about 9 months. For private loans, the timeline is often shorter, sometimes just 90 days. When a loan defaults, it's like the lender saying, you've officially broken the deal. Your credit takes a big hit, and the government can take serious action to get their money back. For example, imagine you owe $25,000 in federal loans and stop paying. After 9 months, your loan defaults. From that point, your wages can be garnished, your tax refunds can be seized, and your credit score might drop by over 100 points. Default isn't the end of the road, but it's definitely a hard bump. Number 2. The immediate consequences of default. Here's what most people don't realize. When you default, the government doesn't need to take you to court to collect. They can start taking money directly from your paycheck or your tax refund. Let's say you work a job earning $800 per week. The government can legally take up to 15% of your disposable income. That's about $120 gone automatically every week. And it doesn't stop there. Your entire unpaid balance becomes due immediately. Your credit report gets a black mark that can last for 7 years. And you lose access to programs like deferment, forbearance, or income-driven repayment. If you had a cosigner, they're in trouble too. Their credit will also take a hit, even if you were the one responsible for paying. So, yeah, default can hurt more than just your wallet. It affects your reputation with lenders, landlords, and even employers. Number 3. The hidden cost of default, fees and interest. When your student loan defaults, it's not just your balance you have to worry about. The government adds collection costs, which can be as high as 25% of your balance. So that $25,000 loan, it can suddenly turn into more than $31,000 just from penalties and fees. Then, interest keeps building on top of that. It's like a snowball rolling downhill, getting bigger the longer you wait. This is why so many borrowers feel trapped. Even if they want to fix it, the balance looks impossible. But don't lose hope. There are ways out. Number 4. What happens to your credit score? When your loan goes into default, your credit score doesn't just dip, it crashes. A defaulted student loan can lower your credit score by 100 to 150 points, depending on your overall credit history. That can make it harder to get approved for a car loan, a mortgage, or even rent an apartment. Let's say your score was 700 before default. Afterward, it might drop to around 550. That's the difference between good credit and poor credit. The good news? Once you start taking steps to fix the default, your credit can recover over time. But it requires consistency and patience. Number 5. Can you go to jail for defaulting? No, you cannot go to jail for defaulting on student loans. This is one of the biggest myths out there. The USA doesn't have debtors' prisons. You can't be arrested for owing money. However, ignoring your loan entirely can lead to wage garnishment or your tax refund being taken. You might even have your Social Security benefits reduced if you default later in life. So while there's no jail time, the financial penalties can feel just as scary if you don't take action. Number 6. What you should do immediately after defaulting. If your loans have defaulted, the worst thing you can do is ignore them. The longer you wait, the harder it gets to recover. Step 1. Find out who owns your loan now. Defaulted federal loans often get transferred to a collection agency. You can check your loan status on the federal student aid website, studentaid.gov. Step 2. Contact them. Explain your situation. Ask about options like rehabilitation or consolidation. Step 3. Start making small, affordable payments. Even $20 or $30 per month shows effort. that can open the door to rehabilitation programs that remove the default from your record entirely. Think of it like building a bridge back to good standing, one payment at a time. Number 7. Loan rehabilitation, your second chance. Loan rehabilitation is the government's way of saying, okay, let's start over. Here's how it works. You agree to make 9 on-time, affordable monthly payments within 10 months. These payments are often based on your income. Once you complete the program, your loan is taken out of default, wage garnishment stops, and the default mark is removed from your credit report. Let's say you earn $2,000 a month. Your rehabilitation payment might be as low as 5% of that, around $100 per month. After 9 payments, your credit starts healing, and you're eligible again for deferment, forbearance, and income-driven repayment plans. It's one of the best ways to get back on track without paying the entire loan off at once. Number 8. Loan consolidation, a faster, simpler fix. Another way to get out of default is through consolidation. You can combine your defaulted federal loans into a new direct consolidation loan. To qualify, you must either make 3 on-time monthly payments or agree to repay under an income-driven repayment plan. The big advantage: your loan leaves default status immediately once consolidation is approved. But here's the catch: the default stays on your credit report. It won't be erased like in rehabilitation. So consolidation is quicker, but rehabilitation gives you a cleaner slate. If you're in a hurry to restore eligibility for aid or get wage garnishment stopped fast, consolidation may be your best move. Number 9. What about private student loans? Private loans work differently. They don't offer rehabilitation or federal programs. Once you default, the lender or collection agency can sue you in court to collect the money. If they win, they can garnish your wages or put a lien on your property. Your best move with private loans is to contact the lender as soon as possible. Explain your financial situation and try to negotiate a new payment plan. Sometimes, lenders will offer a settlement where you pay a portion of what you owe, say 60%, and they forgive the rest. But remember, any forgiven debt might be taxable income. So always check with a tax advisor before agreeing to a settlement. Number 10. The Fresh Start Program, a golden opportunity. In 2024, the Department of Education launched a temporary program called Fresh Start. It gives borrowers with defaulted federal student loans a one-time opportunity to bring their loans back into good standing. No rehabilitation required. You just need to contact your loan servicer or the Department of Education to enroll. Once you're in, your default status is cleared, collections stop, and you regain access to financial aid. For example, let's say your loans defaulted 5 years ago, and you've been avoiding them out of fear. Under Fresh Start, you can restart payments as if nothing happened. But here's the catch: it's temporary. Once the program ends, this chance disappears. So if you're eligible, act now. Number 11. Rebuilding your credit after default. Once you've fixed your default, the next step is rebuilding your credit. Start by paying all your bills on time, every month. Even small on-time payments have a huge positive impact on your credit score over time. Second, keep your credit utilization low. That means using less than 30% of your available credit on cards. Third, consider getting a secured credit card or a credit builder loan to re-establish positive payment history. For example, if you put $300 down on a secured card and make payments on time, it shows lenders you can be trusted again. Within a year or two, you could see your credit score climb by 100 points or more. Number 12. Avoiding default in the future. Once you're out, you never want to fall back in. The key is prevention. Sign up for income-driven repayment. These plans adjust your monthly payment based on your income, sometimes as low as $0 per month if you're unemployed or struggling. You can also apply for deferment or forbearance if you're facing financial hardship. And always update your contact information with your loan servicer. You'd be surprised how many people default simply because they missed important mail or emails. Think of your loans like a pet. You have to keep an eye on them. Ignoring them will only make things worse. Number 13. Can defaulted loans affect your future education? Yes. If you default on a federal loan, you lose eligibility for additional federal student aid. That means no new loans or grants until you fix the default. So if you ever plan to go back to school, you'll need to get out of default. First through rehabilitation, consolidation, or the Fresh Start program. Once you're back in good standing, you can reapply for aid and continue your education without the financial roadblock. Number 14. What about bankruptcy? Can it help? Bankruptcy doesn't easily erase student loans. You have to prove undue hardship, which is very difficult to qualify for. That said, there's been progress. Recent policy changes have made it slightly easier for borrowers in extreme situations, like long-term disability or severe financial distress, to discharge their student loans in bankruptcy. Still, it should be your last resort. Try rehabilitation or consolidation first. Bankruptcy can destroy your credit for years, while rehab actually helps rebuild it. Number 15. The emotional side of default. You're not alone. It's easy to feel ashamed or hopeless when your loans default. But remember, millions of Americans have been exactly where you are. According to the Federal Reserve, more than 7 million borrowers in the USA are currently in default. You are far from alone. What separates those who recover from those who stay stuck isn't luck, it's taking that first small step. Maybe that means making one phone call today, or setting up one small payment plan. Every step counts. Number 16. What happens if you ignore the default? Ignoring your defaulted student loan might feel easier in the short term, but in reality, it's one of the most damaging things you can do financially. When you ignore your default, interest continues to build every single day. The government can take your tax refunds, garnish your wages, and even withhold portions of your Social Security income later in life. For example, if you're owed a $2,500 tax refund, the government can legally take the entire amount to put toward your defaulted loan, and you won't get a warning before it happens. The longer you ignore it, the more you'll owe. And once your loan is sent to a collection agency, the pressure and the costs will only grow. Number 17. How wage garnishment really works. When your loan is in default, wage garnishment allows the government to take money directly from your paycheck without your permission. This is called administrative wage garnishment. They can take up to 15% of your disposable income. So, if you bring home $600 a week after taxes, nearly $90 could be taken automatically before you even see it. The worst part, you might not even notice it until your paycheck is smaller, and you can't stop it easily, unless you get your loan out of default through rehabilitation or consolidation. This is why acting quickly is so important. You want to fix the problem before wage garnishment begins. Number 18. How tax refund seizures happen. If you default, your tax refund can be taken through something called a treasury offset. That means when you file your taxes and expect a refund, the Department of Education can redirect that money toward your defaulted loan balance instead. Imagine waiting all year for a $1,800 refund, only to see $0 hit your bank account. That's what happens when your loan is in default. You can stop future offsets by bringing your loan back into good standing. But once your refund is taken, it's gone. There's no getting it back. Number 19. How default affects cosigners and family members. If someone cosigned your loan, your default becomes their problem too. Their credit score can drop, they might start receiving calls from debt collectors, and their own ability to borrow can be limited. For example, if your parent cosigned your $20,000 student loan and you default, their credit could drop from 750 to 600, making it harder for them to qualify for a mortgage or car loan. That's why communication is key. If you're struggling to pay, talk to your cosigner early. Working together on a repayment plan can prevent serious damage to both of your finances. Number 20. How default impacts your job opportunities. Believe it or not, a defaulted student loan can hurt your job prospects. Some employers, especially those in finance, security, or government, check credit reports during the hiring process. Seeing a loan default might raise red flags about reliability or responsibility. It doesn't mean you'll never get hired, but it can make things harder. Imagine two candidates applying for the same position. One has clean credit, the other has a defaulted loan. Employers often go with the candidate who looks more financially responsible. Getting your loans out of default not only restores your finances, it can protect your career too. Number 21. How to handle debt collectors the smart way. Once your loan is in default, you'll likely get calls from collection agencies. They might sound intimidating, but you still have rights. You can ask them to verify the debt in writing. You can also request that they contact you only by mail. Never give out personal details like your bank account number over the phone unless you've confirmed you're speaking with a legitimate agency. And remember, you can negotiate. Collection agencies often accept smaller monthly payments to show good faith or even offer a settlement. The key is to stay calm, get everything in writing, and never agree to something you can't afford. Number 22. The difference between federal and private loan defaults. Many borrowers don't know that federal and private loan defaults are treated completely differently. With federal loans, the government has powerful tools like wage garnishment, tax refund offsets, and Social Security withholding. They don't need to sue you first. Private lenders, on the other hand, must go to court and win a judgment before they can garnish your wages or seize property. That means if you default on a private loan, you'll likely receive legal papers before anything is taken. The best way to know which type you have is to check your loan information at studentaid.gov. Knowing your loan type helps you understand what actions your lender can legally take and how to respond strategically. Number 23. Can you settle a defaulted student loan? Yes, in some cases, you can. For federal loans, the Department of Education sometimes allows settlements, though it's rare. You might be able to pay a lump sum that's less than your full balance. For example, if you owe $30,000, you might be offered a one-time settlement of $24,000. Private lenders are usually more open to settlements because they'd rather get something than nothing. But be careful, settlements can have tax consequences. Any forgiven debt may be counted as taxable income. So talk to a tax advisor before agreeing. Number 24. How income-driven repayment can prevent default forever. One of the best tools to avoid future defaults is an income-driven repayment plan, often called IDR. These plans cap your monthly payment at a small percentage of your discretionary income, sometimes as low as 10% or even $0 if your income is low enough. For instance, if you make $2,000 a month, your payment could be just $100 or less. It adjusts automatically each year based on your income. So even if you lose your job or earn less, your payments shrink too. This flexibility is why IDR is one of the most powerful tools to prevent future defaults. Number 25. How student loan forgiveness fits in. If you work in certain public service jobs, like teaching, nursing, or government, you might qualify for Public Service Loan Forgiveness, PSLF. This program forgives your remaining loan balance after you make 120 qualifying payments while working full-time in a qualifying job. But here's the catch. You must get out of default first. Defaulted loans don't count toward forgiveness programs until they're rehabilitated or consolidated. So, if forgiveness is your goal, fixing your default is your first major step. Number 26. Can you buy a house with defaulted student loans? It's very difficult, but not impossible. Defaulted loans can stop you from getting certain types of mortgages, like FHA loans, because the government tracks defaults through a system called seizures. If your name is in that database, you won't be eligible for a federally backed mortgage until you clear your default. Once you rehabilitate or consolidate your loan, your name is removed from seizures, and suddenly, homeownership becomes possible again. Many people don't realize that fixing their student loan default can literally be the key that unlocks their dream home. Number 27. How default can affect your tax filing and spouse. If you're married and file taxes jointly, your spouse's refund can be taken too through the Treasury Offset Program, even if the student loan is only in your name. However, your spouse can file an injured spouse claim with the IRS to get their portion of the refund back. So, if you're in default and married, talk to a tax professional before filing your taxes together. It could save your spouse thousands of dollars. Number 28. The role of collection agencies, what they can and cannot do. Collection agencies have limits. They can't harass you, threaten to arrest you, or call at odd hours. Federal law, the Fair Debt Collection Practices Act, protects you. If an agency violates these rules, you can report them to the Consumer Financial Protection Bureau or your state attorney general's office. Remember, just because you owe money doesn't mean you lose your rights. Staying informed keeps you in control. So now you know the truth about defaulted student loans, what happens, how to fix it, and how to rebuild your financial future. But here's the question I want to leave you with. If you knew that one phone call could start erasing years of stress and debt, would you make it today or keep waiting until tomorrow?